Imagine walking into a store tomorrow and realizing you no longer have cash. Not just coins or bills, but that the very concept of physical money is disappearing. Your every purchase, your every transaction could be tracked, traced, and controlled. Now imagine this isn't some distant dystopia, it's happening right in the heart of Europe. The European Central Bank has quietly been building what experts call a digital euro. On the surface, it's presented as a modern convenience, a safer, faster way to pay. But behind the headlines, some economists, privacy advocates, and even former central bankers warn it could fundamentally change the way we think about money and freedom. Is Europe secretly ending cash? Could your wallet become obsolete sooner than you think? And most importantly, why are governments pushing this change now? Today, we'll dive deep into the history, the players, and the hidden financial mechanisms that could make cash a relic of the past. To understand the digital euro, we first need to understand why cash exists at all. For centuries, cash has been more than just a tool for buying groceries or paying rent. It has been a symbol of autonomy, a shield against surveillance, and a cornerstone of trust in financial systems. Central banks, from the Bank of England to the Federal Reserve, have historically issued physical money as a liability of the state. In simpler terms, the money in your pocket represents a direct promise from a central authority. This is legal tender, and its value is guaranteed. But here's the twist. The rise of digital transactions has made cash increasingly inconvenient for governments and banks. Every bank, deposit, card, swipe, or mobile payment leaves a digital footprint. Physical cash, on the other hand, is untraceable. In a world where financial oversight is growing, cash becomes not just inconvenient but a problem for those who want to monitor economic behavior. The digital euro is Europe's proposed answer to this tension. Officially, it's pitched as a complement to cash, not a replacement. But hints from leaked reports, policy papers, and speeches by European Central Bank officials suggest something more ambitious and more controversial may be underway. The idea of a central bank digital currency, CBDC, didn't emerge overnight. It dates back to the early 2010s, when global interest in digital money was skyrocketing. Bitcoin's rise caught the attention of financial regulators worldwide. While governments were skeptical of cryptocurrencies, they recognized a critical insight. Digital currencies could bypass traditional banking infrastructure and potentially bypass state control. European policymakers began asking a crucial question. What if we could create a state-backed digital currency that combined the convenience of digital money with the security of central bank backing? By 2014, the European Central Bank (ECB) had begun researching the concept. Key figures in this movement included Benucci, head of the ECB's Market Infrastructure and Payments Division, and Fabio Panetta, who now leads the Digital Euro project. Their vision was clear. A digital euro could streamline payments across the Eurozone, reduce costs, and make the financial system more resilient. Yet, lurking beneath these efficiencies was a controversial implication. A digital euro could allow the central bank, or by extension, governments, to monitor every transaction in real time. For critics, this wasn't just a technological innovation, it was the beginning of a new form of financial oversight. Fast forward to the late 2010s, Europe was recovering from the 2008 financial crisis, the Eurozone debt crisis, and a wave of digital innovation. Governments faced rising debt, slowing economies, and increasing pressure to modernize payment systems. Meanwhile, commercial banks are quietly positioning themselves for the shift. Major players like Deutsche Bank, BNP Paribas, and Ing are exploring ways to integrate digital euros into consumer accounts. This creates a subtle incentive. The more people adopt digital accounts, the closer Europe moves to a cash-light traceable economy. The key tension is clear. Convenience versus privacy. Modernization versus autonomy. Efficiency versus freedom. These tensions set the stage for what happens next. The rise of CBDCs, a growing push toward reducing cash circulation, and a series of economic experiments that could reshape Europe forever. The tension between convenience and control reached a tipping point in 2023. The ECB announced plans for pilot programs across multiple Eurozone countries, including digital wallets linked directly to central bank accounts. Unlike traditional bank deposits, these accounts were designed to bypass commercial banks entirely, giving the ECB unprecedented oversight of personal spending. At the same time, cash usage was in sharp decline. Data from the European Central Bank showed that in some countries, cash payments accounted for less than 40% of total transactions, down from 80% just a decade earlier. Governments quietly cited efficiency and hygiene as reasons, while the true drivers were far deeper: traceability, control, and policy flexibility. Experts warned this could trigger a fundamental shift in economic power. With digital euros, central banks could impose negative interest rates directly on citizens' holdings, limit or restrict purchases in real time, monitor behavior, and enforce compliance with financial policies instantly. Some commentators have likened this to handing governments a digital leash for every euro in circulation. Even as pilots rolled out, resistance began to appear. Citizens, activists, and some lawmakers raised concerns over privacy, autonomy, and economic freedom. In Germany, privacy watchdogs criticized the ECB for failing to implement adequate data protection safeguards. Meanwhile, commercial banks, once reluctant participants, started promoting digital euros to customers as a modern, convenient alternative. But behind the marketing, internal memos revealed a subtle strategy. The faster citizens adopt digital accounts, the harder it becomes to return to a cash-based system. This creates a potential domino effect. 1. Citizens adopt digital euros for convenience. 2. Cash transactions decline further. 3. Governments gain leverage to regulate or eventually phase out cash. At the same time, economists pointed out a risk of exclusion. Vulnerable populations, elderly citizens, rural communities, and low-income households often rely on cash. Transitioning too quickly to digital-only systems could leave these groups financially marginalized, sparking ethical and political debates. Policymakers recognized a potential backlash. To ease fears, the ECB and European governments proposed temporary safeguards, limits on the amount of digital euros an individual could hold, optional privacy layers to mask transaction details from authorities, pilot programs emphasizing voluntary adoption. Yet, many analysts argue these fixes are symbolic rather than structural. While limits exist on paper, the infrastructure allows future adjustments with little notice. Optional privacy layers can be removed or overridden. Even voluntary adoption could evolve into subtle coercion, discounts, incentives, or reduced access to services for those who insist on cash. The story of the digital euro is more than finance. It's a test of society's ability to balance innovation with personal liberty. How we respond now could define financial freedom for generations to come. If this video opened your eyes to the hidden forces shaping our money, make sure to hit the like button and subscribe for in-depth analyses on global finance, emerging technologies, and economic trends. Share your thoughts below. Do you think a cashless Europe is inevitable, or can citizens push back and preserve cash for the future? Finally, if you want to stay informed before the digital euro arrives in your wallet, turn on notifications so you never miss our latest videos exposing the hidden side of money.